Hello everyone. Today we discuss about standard costing. So cost control is one of the objectives of cost management. Management of an organization setups predetermined cost to compare the actual cost with the predetermined cost. Predetermined costs are standard costs used for cost control and performance evaluation. Standard costing is a method of cost and management accounting which starts with setting of standards to reporting of variance to management for taking corrective actions. The official terminology of CIMA London defines standard costing as control technique that reports variance by comparing actual cost to preset standards, so facilitating action through management by exception. So, what is standard or standard cost? Standard cost is defined in CIMA official terminology as the planned unit cost of the product, component, or service produced in a period. The standard cost may be determined on a number of bases. The main use of standard cost is in performance measurement, control stock valuations, and in the establishment of selling prices. So, planned cost and determined on a base or number of bases. Why standard costing is needed? Standards or standard cost are established to evaluate performance of a responsibility center. Apart from performance evaluation and cost control, standard costs are also used to value inventory where actual figures are not reliably available and to determine selling prices, particularly while preparing quotations. Standard costing system is widely accepted as it serves different needs of an organization. The standard costing is preferred for the following reasons that I mentioned right now. Predictions of future cost for decision making. Standard costs are set after taking all present conditions and future possibilities into considerations. Hence, standard cost is future cost for the purpose of cost estimation and profitability from a proposed project, order, or activity. Provide target to the achieved. Standard cost are the target cost which should not be crossed by the responsibility centers. Performance of a responsibility center is continuously monitored and measured against the set standards. Any variance from the standard is noted and reported for appropriate action. Used in budgeting and performance evaluation, standard costs are used to set budgets, and based on these budgets, managerial performance is evaluated. This is of two benefits. One, managers of a responsibility center will not compromise with the quality to fulfill the budgeted quantity, and second, variance can be traced with the responsible department or person. Now, interim profit measurement and inventory valuations. Actual profit can only be known after the closure of the accounts, but an organization may need to prepare profitability establishment or statement for interim periods for managerial reporting and decision making to arrive at profit figure. standard costs are deducted from the revenue. Now, standards or types of standards. Ideal standards, these presents the level of performance attainable when prices for material and labor are cost favorable. When the highest output is achieved with the best equipment and layout, and when the maximum efficiency in utilizations of resources results in maximum output with minimum cost. So these types of standards are criticized on three grounds. Since such standards would be attainable, no one would take these seriously. This variance disclosed would be variance from the ideal standards. This would not therefore indicate the extent to which they could have been reasonably and practically avoided. There would be no logical method of disposing of these variants. Normal standards, these standards that may be achieved under normal operating conditions. The normal activity has been defined as the number of standards, hours, which will produce at normal efficiency sufficient good to meet the average sales demand over a term of years. These standards are, however, difficult to set because they require a degree of forecasting. The variance thrown out under these systems are deviation from the normally efficiency. So, normal sales volume or normal productions volume, if the actual performance is found to be abnormal, large variance may result and necessitate revisions of standards. Basic or bogey standards. These standards are used only when they are likely to remain constant or unaltered over a long period. According to these standards, a base year is chosen for comparison purposes. In the same way as statisticians use price indices, since basic standards do not represent what should be attained in the present period, current standards should also be prepared. If basic standards are used, basic standards are, however, well suited to businesses having a small range of production and long production runs. Basic standards are set on a long run basis and are seldom revised. When basic standards are in USA or are used or in use, variance are not calculated. Instead, the actual cost is expressed as a percentage of basic cost. The current cost is also similarly expressed, and the two percentage are compared to find out how much the actual cost has deviated from the current standards. The percentages are next compared with those of the previous periods to establish the trend of actual and current standard from basic cost. Now, current standards. These standards reflect the management anticipations of what actual cost will be for the current period. So these are the costs which the business will incur if the anticipated prices are paid for the goods and services, and the uses corresponds to that believed to be necessary to produce the planned output. The variance arises from expected standards, present the degree of efficiency in uses of the factors of production, variation in prices paid for materials and services, and difference in the volume of productions. Now, the process of standards costing. The process of standards cost. First, setting of standards. The first set is to be set standards which are to be achieved. The process of standard setting is explained. Ascertainment of actual cost. Actual cost for each components of cost is ascertained. Actual costs are ascertained from books of account, material, invoices, wage sheet, charge slip, etc. Comparison of actual cost with standard cost. Actual costs are compared with the standard cost and variance are determined. Investigate the reasons for variance. Variance arises are investigated for further action based on these performance is evaluated and appropriate actions are taken. Dispositions of variance. Variance arises are disposed of by transferring it the relevant accounts costing profit and loss account as per the accounting method plan adopted. Now, setting up of standard cost. Standard cost is set on the basis of management estimations. Cost is estimated on the basis of technical specifications provided by the engineering department or other experts such as production engineer. Generally, while setting standards, consideration is given to historical data, current productions plans, and expected conditions of future. For the sake of detailed analysis and control, standard cost is set for each elements of cost, that is material, labor, variables, overheads and fixed overheads. Standards are also set for the sales quality and sales value. This is generally known as budgeted sales. So standards are set in both quantity, units or hours, and in cost, price or rate. It is thus measured in qualities or quantities, hours and value of the factors of productions. So standard costs are divided into three main cost components such as direct materials cost, direct employee labor cost, and overhead. So standards are set both physical and monetary terms for each cost components. So in the next episode, I will discuss about physical standards. Thanks again for watching my videos, and if you like my blogs, please subscribe and share my blogs. Thanks again.